Hello, I'm Sim, a finance geek and a self-proclaimed foodie, and welcome back to my YouTube channel. Today we're talking about how the Fed's moves impact the US stock market. The Fed essentially has a dual mandate: maximum employment and stable prices. It does this by controlling the money supply in the economy by either raising or lowering interest rates when the economy is growing too fast or too slow. It's called the monetary policy in economics, and what it basically means is if the Fed were to cut rates, it would reduce the borrowing costs for homes, cars, and various other major purchases that would fuel growth in the economy and higher stock prices. The Fed raised their benchmark interest rates from around near zero in early of 2022 to 5.25 to 5.55%, the level it's been at since July of 2023. Inflation has come down a bit, which was the main reason that the Fed raised the interest rates to begin with. While borrowing costs soared, the housing market slowed and bond yields increased, which is why a lot more people went towards investing in bonds than in stocks. If the Fed does cut interest rates now, inflation could creep back up. An important inflation gauge that is being watched by the Fed that tracks core prices shows a rate of 2.9% over the past 12 months. That's honestly great improvement from the peak of 5.6% in early 2022, and on a 6-month basis, core inflation is actually slightly below the Fed's target inflation rate of 2%. This decrease in inflation rate does open doors for the Fed to decrease the rates, but there's always a risk of cutting it too soon. If rate cuts do open the floodgates for spending, prices could rise faster than what the Fed wants. Interest rates affect the stock market in so many different ways, but in general, companies are better off when they can borrow money cheaply and when consumers are spending freely. For similar reasons, when interest rates are low, you also tend to see more GDP growth and more hiring. Because of this high rate, we've also seen a lot of consumer discretionary companies perform poorly, which includes mainly apparel retailers, restaurants, and car makers. One of my favorite brands of all times, Express, just announced bankruptcy. Starbucks and Airbnb both performed poorly this earnings season as well. So now in the Fed meeting, Powell was very clear on the next steps. The Federal Reserve announced that it's going to be holding the interest rate steady following its April 30th and May 1st meeting, leaving the federal funds rate at a target range of 5.25 to 5.5%. It's the 7th time in the last 8 meetings that the Fed has left the rates unchanged, though the central bank has raised rates a total of 11 times during this economic cycle in an effort to tamp down the inflation. The Fed chair said that the central bank was willing to sit tight until the inflation situation changes. It is likely that gaining such greater confidence will take longer than what they had previously expected, and that they are prepared to maintain the current target federal funds rate for as long as required. The Fed targets a long-term 2% inflation rate, but most recently the Consumer Price Index, or the CPI, is 3.5% for the 12-month period ending in March. At the same time, the so-called core inflation rate, which excludes volatile food and energy sectors, rose 3.8% over the same one-year period. Now, if you do believe that the Fed is going to cut interest rates later this year, probably not in their June meeting at all, because they are seeing inflation in control, then you should buy consumer discretionary stocks and enter in at a great price right now, especially companies like Starbucks and Airbnb. And also you can think of investing in real estate companies and car companies as well. But if you do believe that the Fed won't be cutting rates anytime this year because inflation won't be under control, then you should be investing in consumer staple stocks. Companies that manufacture products for people that they need on a daily basis, so companies like Nestle and Unilever. What do you think is Fed's move for the rest of the year? Tell me in the comments, I'd love to chat with you. If you found this video helpful, don't forget to subscribe to my channel. Bye!